Welcome to this special episode of Lunch Money, brought to you by Sharesies. At Sharesies, our purpose is to create the most financially empowered generation. For those of you who are new to Lunch Money, we do these every Thursday at lunchtime. This is a place where you, as investors, can hear from the people leading some of the companies available on the Sharesies platform, as well as other investing experts. Lunch Money is also available as a podcast on Spotify, Apple Podcasts, and Google Podcasts. If you're listening to us on Apple Podcasts, we'd really appreciate it if you could take a moment to leave a rating and comment. My name's Erin, and I'm the Head of Finance here at Sharesies. Before we get into the fun stuff, I have a small legal disclaimer for you all. Investing involves risk. You aren't guaranteed to make money, and you might lose the money you started with. Any information we provide is general only and current at the time. If you're looking for help with your investment choices, we recommend talking to a licensed financial advice provider. We won't be providing any personalised advice as part of this webinar. Also, just a quick reminder, if you have any questions for us, you can submit them through the Ask a Question button down below. Don't leave questions in the discussion area as they're likely to get missed. Please be kind and respectful towards our speakers and your fellow viewers. Otherwise, we'll have to take steps to remove you from this webinar. Today, we're bringing you a really special episode of Lunch Money. This week is Money Week, and the theme this year is Just Wondering. It's an invitation to talk about money and to ask for help with any financial questions. And to help with this, we're joined by no less than three awesome guests today. Firstly, we have Tom Hartmann, the managing editor at sorted.org.nz. We're also joined by Sam Stubbs. He's the co-founder and managing director of Simplicity, a non-profit fund manager and Kiwisaver provider. And last but not least, someone very familiar, we have Sonya Williams, a Sharesies co-founder and CEO. Welcome, everyone.
Kia ora.
Kia ora.
Kia ora. Hi there.
Hi, thank you so much for joining us today. I thought that I would actually kick off with a little quickfire question for all of you. So what I'm really keen to hear is, what's your money story? What has your personal journey with money looked like so far? And Sonya, I thought maybe we could start with you.
Yeah, cool. It's pretty hard. It's a pretty hard question to answer, actually, because money's kind of always, been around or it hasn't. But I think categorizing it, my mum taught me lots about money, and we had lots of kind of self-help books or money books in my household. So I'd say I grew up pretty money curious, but didn't really know what that means because I'm from a small town, didn't really know what was possible or available to me. So always money curious, but always felt like I didn't quite know what I needed to know. Then I, started earning my own money. I probably went towards more of the saver mindset, pretty what I would call risk aware. And then I think it all kind of came to a head for me when I started working at a bank after building a career in technology. And although I thought I knew a bit about money, it really became aware how many gaps I had personally when I started working at a bank. And thought that there's just so much more I'd love to know and so much more I'd love to share with all New Zealanders, because I think there is a lot of how we can be more empowered with money. But that kind of idea is what, how Sharesies started, just this idea of how can money be this empowering thing, and how can we all have what we need to get ahead with money. So, yeah, that's a bit about my journey with money. Yeah.
Nice. It's so interesting. Tom, what about you?
Yeah, so my story with money is kind of interesting. So I'm originally, as you can hear from my accent, so I'm from New York City, and I grew up in a really unusual way because I'm the oldest of 10 kids, and so a really big family, and so always money was really tight with us all growing up. And I'm trained in journalism, but then I also worked in the mortgage industry, and I sort of had a front row seat when lots of things blew up at the great financial crisis back in 2008. And for the better part of the year, actually, I was working for a bank, not unlike Sonya, where a lot of my eyes were opened about how it all works behind the scenes. And I spent the better part of a year actually analyzing people's credit reports for a bank and pushing their mortgage deals through to funding. And so I began to get a lot of insights into how people manage their money, the choices they had made, which are obviously different than mine, and how mortgages work in general. And then when I moved here to New Zealand, which is about 11 years ago now, this possibility to work for Sorted came up, and it brought those two things together. So the journalism and working in the mortgage industry, and it's really been a great opportunity in order to help people with their finances and create great tools and guides. And this week for Money Week, we're sort of victims of our own success. We opened the doors to all money questions possible, and people have been sending hundreds and hundreds in. We've been here behind the scenes typing our arms off, answering people's questions, and it's just fascinating. It's a privilege, actually, to work on. So happy Money Week, everyone.
Yeah, huge week for you. Thank you so much for spending time talking to us today when you've got all those emails to answer.
Oh, this is all part of it. Thank you.
You good, Sam?
Oh, sorry, Erin. You froze on my screen there. Cool. So, well, I'll be real quick, but two quick journeys. My personal money was a little bit like Tom. I grew up on the wrong side of the railway tracks, so no money in my family, and so I just learned to work and got very lucky, and I've been managing money my whole life, my own money and other people's money, and that's been fantastic. But my journey has been getting wealthier and wealthier and wealthier, and then feeling guilty about it, and then giving it back and back and back and back and back. So living with less and having a much happier life accordingly. My journey with money has been, shares and bonds and oil and gold and all these sort of things in various parts of the world. So money has always been what I've done for a job, really, pretty much. And my personal journey with money has been one of learning that poverty sucks. B, having enough money gives you choices and dignity in life, and that's what simplicity is all about, making people wealthier so they have dignity. But there is also such a thing as too much, and it is not the sole source of happiness, and more does not necessarily mean more happiness. But, for quite a long time it does.
It's a really interesting one. Obviously, money is a big part of your lives and also a big part of your careers, but money can also be a bit of a taboo topic in society. It feels like maybe that's shifting over time, but I was interested to hear your views on whether it's still taboo to talk about money or people are getting more comfortable in that space.
Well, it depends where you are, right? So when you're in New York, Tom will know this, people discuss their salaries in supermarket queues over there. So money's not a taboo subject at all in some cultures, and in others, and New Zealand's got English heritage, really. It is taboo. We don't talk about it.
Tom, did you find that? Did you see a difference when you came over to New Zealand?
Well, there are lots of differences. It's hard to describe. That's interesting you say that, Sam, because obviously there's many different slices to New York. So it depends where you are in New York and who you're hanging out with. And in the finance industry, that will happen. Sonya and I were just talking about this, though, how money has become mainstream, right? And I think that in a lot of ways that's really true. We're really seeing the benefits of actually talking about choices, about options, about what's available to us. In theory, all the information is out there online, available at our fingertips that we should need, but piecing it together is possibly the more difficult thing. What I hear from financial advisors, for example, a lot of people come in and they know a lot about one thing or a couple things, but in order to join it all together and really get into that growth pattern that Sam was talking about over long periods of time, you really need the support of the people around you.
It's so fascinating because I think back even to like 4.5 years ago, when we were starting Sharesies, it was money just wasn't something that people were talking about, and that was one of the big problems. And the reason that's a problem is what is it about when we did our research with people anyway and started talking to people about money, they would say words like shame and guilt and that's and Sam, you mentioned it there as well, like even if you've got a lot of money, there can be a lot of guilt associated with that as well. And so it kind of didn't matter how much you were talking, whether you had money or didn't, this idea of this guilt and shame. And I think what we're seeing shift and now that people are talking about it a bit more, is it's going from this kind of place of judgment or personal judgment to a place of acknowledgement and going. And I think people are just getting more and more curious and supportive of each other, because you realize you actually have to everyone's kind of in a similar boat. No one's really nailing where they think they want to be with money. They're always thinking that there's more to learn. So I think seeing it, what I'm noticing is this shift between it being about judgment to being about acknowledgement, and then going, hey, look, hey, we can all, get to where we need to go, or learn something we didn't by talking about it.
Cool. I'm keen to move on and combine two really big topics. So I'd love to talk about money and COVID. So last year during Money Week, we also spoke about COVID. And one thing that was discussed was the most common questions and concerns that Kiwis had during COVID-19 and the financial impact that it had on people's lives. I'm interested to hear your views now that we're a year or so on. Do you think things have changed for Kiwis? Do you think they're still talking about COVID and money? Do you think it's changed any of their behaviours?
I think I can maybe kick off. I think definitely, like, what we saw for Sharesies was huge growth last year of people wanting to start investing, and that was spurred on. I think what we took from that is it definitely made people reassess where they were at with their money and in their lifestyle, and just kind of brought it front to mind and thought, cool, what can I do? Because who would have predicted that? Probably someone will say someone somewhere predicted it, but let's not worry about that. But
what I find in the financial sector is everybody tries to predict everything, and whoever gets it right gets the bragging rights.
So, but let's just ignore I said that. But this idea of it made it very real for people, and people started asking, what does this mean for me long term when I can't predict things? So definitely think it started a bit of a conversation and brought something to the now. Something, money is always this future focused thing, and when we're dealt with uncertainty, we kind of go, all right, how can we create stability when uncertainty is what's top of mind right now? And so people taking stock, and that's continuing from what we see. People, it really just sparked this curiosity to want to be more resilient or thinking long-term about money, and that's continuing. And now we see the subjects changing, into things around like house prices and interest rates and what all this uncertainty kind of means going forward. So definitely think it started a conversation that is continuing now even. Well, that's what we're seeing.
I'm glad you mentioned the low interest rate environment, because what we're seeing since COVID is people trying to navigate that. There was that uncertainty about work and people working in industries that were heavily affected. But largely now I'm seeing, where is it best to get ahead in an environment where, savings accounts really don't make a lot of sense, especially for the long term. You can find yourself rolling backwards. So we're seeing a lot of interest there.
Yeah, look, COVID was awesome in the sense that it taught us two lessons about money. This is my fifth financial crisis, right? So I was sort of like a little bit eye rolling here when I said, the world's going to end, all this sort of stuff. So two massive lessons. One of them is that this thing psychologically called loss aversion. And that means that you hate losing $1 more than you love making $1, right? So when you go, woo, the markets are crashing, you act out of fear. And when you act out of fear, you do crazy stuff, right, to protect yourself. So you had all these people going, I want it all in the bank to feel safe. And so what you've learned is that, like COVID, if you looked at a 100-year chart of the stock markets, COVID's just a little blip in history. And yet at the time, it feels really scary. So hopefully we've all learned a lesson. Don't trade on fear, right? Fear is a bad motivator. Fear is an awesome motivator if it's going to protect your life physically. It's a really bad motivator in almost everything else in life. By the way, that also counts, and I can speak from experience in relationships, friendships, everything in life, right? You act out of fear, usually a bad decision. That's the first lesson. The second lesson there was then, how do you stop panicking? And that's all about diversification. So even when the markets were going down and you had all these stocks going down, if you own Fisher & Paykel Healthcare, it's going up. And if it's so diversified, that, unless it really is the end of the world, in which case, who cares how much money you've got in your bank account or what you're worth? You're dead anyway. Unless it really is the end of the world, diversification protects you from these moments, and it stops you making panicky, nervous, fearful decisions. So hopefully now people have learnt that lesson and have experienced it once. Trust me, you have to experience it 2 or 3 times, and then it really becomes part of your DNA. I'm sure Sharesies were doing this. Simplicity was on podcasts every single day saying, don't panic, don't panic, don't panic. In history, this is what it shows, but all that stuff. Yeah.
Yeah, we also find a lot that fear-based decision-making with money is just a really bad mix. It's almost like, drinking and driving. Those two things should not go together. You should not make money decisions based on fear.
I remember right at the beginning of COVID in the news, there are a lot of stories around how people were switching their Kiwisavers from, say, a growth fund to a conservative fund. Sam, I was wondering if you could maybe fill us in a little bit more on why Kiwisaver is so important to New Zealanders' financial well-being and how it sort of impacts their lives.
It's super massively important. I can think of 3. I can give you 30 reasons, but let me just give you the big 3, right? First of all, is Kiwisaver is going to be the second biggest asset that most New Zealanders have after their home, even if they own a home. And for those who don't own their home, it might be the biggest asset they'll have. So that's serious, huh? Secondly, is for New Zealand, it is a massive, we're about to enter this renaissance of growth. You heard it here. I don't like to predict financial markets because it's a fool's game, but you heard it here. New Zealand is about to enter a 20 or 30 year period of growth like we've never seen in history, fueled by Kiwisaver. And the reason I say that is because if you look at Australia in the 1980s, when they started saving in their superannuation fund, Australians are 20% richer than New Zealanders. Their GDP per capita is 40% higher, not because they've got iron ore in the ground. They've got iron ore, we've got milk. We're both commodity countries. The reason Australia had 26 years without recession is because they would continue to save in their superannuation funds, which kept, even when there was a little downturn, the building sites kept going, the jobs kept going, the businesses kept on getting funded. So we're about to go through that period. So that's the second reason. It's going to be huge for New Zealand in terms of growth, high-paid jobs. It's going to be a very cool place to be. The third reason about Kiwisaver is it's so safe. When you save in Kiwisaver, the money goes up to a custodian. In our case, it's the public trust. We never touch the money. We can't legally touch your money. All we can do is advise on how it's invested. The money always sits in public trust, which is owned, in our case, owned by the government. So, it's safe. It's going to make a massive difference to the future of New Zealand, and it's going to be a big pool of money that will, fund your first home, fund your retirement, fund you in times of hardship, all that good stuff.
It's pretty amazing too, just to add around the financial behaviors or what that drives, this idea of that money kind of builds bit by bit. And, most people, when we did some research early on into Kiwisaver, most people kind of didn't really even notice it until it became the site. I think it was the value of a car or a value of a new car. And all of a sudden it kind of creeps up and it becomes this big amount, the biggest amount people have seen in a bank account with their name on it, which is hugely empowering. And that happens one payday at a time. So I think this Kiwisaver is also embedding this fantastic financial behaviors around little bits often, building up to become a big amount.
When you think about the role that Kiwisaver has, also, Sam, I'm glad you mentioned, retirement, that long term. Many of you will know about NZ Super. It's basically it's the foundation of a lot of our retirement income. It basically is the main source of income for up to 60% of retirees. But to give you an example, this year for individuals, it pays out $437 a week. Now, many of us on this call will know people who spend more than that on rent or something like that. So obviously, there's a gap. There's a gap between what NZ Super provides and the lifestyle, the future lifestyle that we're looking to have. To bridge that gap, Kiwisaver, is going to be the main thing that fills it in and allows us to really achieve a lot of those long-term lifestyle goals that we'll want to have. So it's really brilliant. We know that it's limited as well because people get unequal outcomes out of it, depending on how much you earn, depending on how much time is in it, depending on how much you contribute. But it has the potential to really bridge that gap in a wonderful way.
I've got one for you, Tom, actually. I recently switched Kiwisaver providers, and when I was making that decision, I started on the Sorted website using some of your tools and calculators. I was wondering if maybe you could fill our audience in on what they should be thinking about when they're choosing a Kiwisaver provider and what they should be looking for, and what might be interesting things to research for them.
Yeah, so Sorted is really in a unique position in that we try to give people an impartial view of the entire Kiwisaver market. And I don't mind saying that when Sam is here, because when you start to compare, usually his team there comes out pretty well. So I can say, though, that we really don't want people going to just one provider. So I don't want you going to Sam in the first instance. I want you to have a look at everything. And really, we've got a whole methodology on how to pick your Kiwisaver fund, because a lot of people might end up doing it because of their favorite brand or because of something they heard or because it's with their bank, and just automatically the brain takes shortcuts, right? It's shorthand. So we developed this whole way. How do you pick a Kiwisaver fund? And where we start is the type of fund. So I imagine you probably started there, Erin, trying to figure out, okay, what type of those 5 types of funds, which go from defensive to aggressive, and most of the time we're talking about balanced, conservative, and growth. Which type is right for your situation? And many of you will know that Kiwisaver is designed for primarily 2 goals, which is a first home or retirement. And so based on what you're going to use it for next, you really can adjust your risk level. And so we narrow it down quickly. Instead of looking at 300 funds, you might be looking at just one at a time. You're looking at, say, 60 funds or 50 funds that are balanced or growth, whatever's right for you. Then we have people look to see whether the fees are reasonable or not. And you can easily compare on our fund finder or on our smart investor tool. And those are tiny little percentages. Sam can go on about this for years and years, but basically tiny little percentages that make a huge deal, tens of thousands of dollars of differences. And then I also survey people like Sam every 6 months to figure out what kind of services they're offering, what kind of communications they have, what's the value they bring to you for your money, how much help they give you with your investment options. So you can come on Sorted to see what the services ratings are like. And then finally, everybody wants to see how these funds perform. Actually, that's what it's really about, getting results. But so we try to show people results from the past 5 years to look at those. But really, those are no real predictor of going forward, even though we are optimists as well. You can't really base your decision on that. But you can look to see if a fund has been subpar to its peers. And that might mean that the fund management hasn't been that great. And so based on those criteria, those are the ones that we really, raise to the top when you're picking your Kiwisaver fund. So I hope you had a good experience and that you found the one for you, Erin.
I did.
There's a good little shortcut there, though, Tom, you talked about, right, which is S. So you think Sorted, Sharesies, Simplicity.
You're there.
So obvious. and then you're covered. Information, investing, Kiwisaver, you're done.
That should have been that could have been the promotion for this panel today.
They missed it.
Keep it simple. Let's all keep it simple.
It is funny because I went through that whole Sorted process and I did end up actually joining Simplicity. So there we go. The trio works.
Thank you.
You're welcome. Sam, did you have any thoughts on what the biggest misconceptions are that people have around Kiwisaver? Any sort of mistruths that you'd like to have an opportunity to disprove?
Yeah, it's amazing. So we get a lot of people in our contact center, and I think it's actually Tom, and I think you can chip in here too, because you've been working this for a long time. One of the most amazing ones is this number of people who still think that it's government guaranteed or that it's a government scheme. And I think that's because the government was just so heavily involved in promoting it.
And they administer it too. So it really, the role of Inland Revenue has really been instrumental just to make sure the money flows into all the funds in the right way.
So I think that's one really big misconception. I think the other one is how much control people have. A lot of people don't realize they can control, the contributions they make, the scheme they're in, the fund profile. And so when you tell them the options they have, that's kind of cool. It's also a bit scary for people too, right? There is such a thing as the thing called the paradox of choice, right? Too much choice makes people make no choices.
It paralyzes us,
Paralyzes us. So there's a little bit of that too. Do you have anything else, Tom? I think those would be the two for us.
Yeah, some people still have some questions about how Kiwisaver and NZ Super work together. Like, okay, if I build up my Kiwisaver, do I still get NZ Super as one instead of the other, and all this sort of thing, which they're meant to complement each other. And then what I mentioned before about those tiny little percentage points, the finance guys, Sam, they'll just count in basis points, right? Which is 1/100th of a percentage point, those tiny little things. But the reason why they count is they make a huge difference. So whether it's in fees, or whether it's in returns, lots of things that seem like they aren't that impactful. Actually, if you run the numbers, they're hugely impactful, tens of thousands of dollars of difference, whether it's the amount that you pay in some funds or it's the amount that you grow over time and it compounds up.
Here's a really simple way of thinking about it, right? The average Kiwisaver fund will return you about 5%. Every finger is 1%, right? Over your lifetime. That's what the sorted website will tell you if you have a look at it. Around about, let's call it 5%. If your fee is 1%, 1% doesn't sound very much, but if you take 1 of 5, that means for every $5 you've made, $1 has gone in fees. That's actually 20% of everything you make. So a 1% fee is 20% of everything you make. That's like a tax rate. That's not a fee, that's a tax, right? So that's how you think. That's why fees are so important. That's why Sorted spends so much time looking at it. That's why we as a non-profit really focus on it. Yeah.
Sonya, I'm interested in your views on how investing also fits into New Zealanders' financial wellbeing. I know that obviously I regularly contribute to my Kiwisaver, but on the side I also have a Sharesies account, and I personally chuck some money every week into a range of different ETFs and a few different companies that I'm interested in. How do you think that investing aspect also adds to people's financial wellbeing in New Zealand?
Yeah, that's a awesome question, Erin. I think, when we've talked a bit about, what is financial well-being and is this place around like the sense of security or this feeling that you've got what you need. And I think where investing comes in is it's really about the kind of the growth and the opportunity side of that well-being. And Sam talked about fear before, and fear definitely, or being prepared to weather the storms, is a really important part of the financial well-being. But also this idea of like, how can I use money, or how can I get into a place where I can live the life that I choose to live and have what I need to be able to make great choices to actually really thrive in my life. And I think that's where understanding and building your investments, like investments is all, it's all about the hope to grow and the opportunity that provides. So I think it's a great way of growing your assets and putting your money to work. So typically people invest because they want to make money. The way that you make money is in the value of a business going up or in that business paying dividends. So there's different ways there. But also I think, talking about, I guess, the attitudes with Kiwisaver or one of the things there, because I think that has helped lots of Kiwis feel, build up this kind of investment portfolio, but to the point where they don't really know that it's an investment portfolio. And I think that's where, really being an active or participant or peeking behind the curtain and being in the driver's seat helps. We know that people have become more aware of their Kiwisaver and asking more questions about their Kiwisaver and what that means and what it's being invested in. And this type of curiosity is so important because it helps us really make sure we're shaping the portfolio that's right for us. So to your point, Erin, this kind of suite of thing, you've got your Kiwisaver and then you've got some contributions going to Sharesies as well. We kind of don't see it as a one thing. It's like a drop in every bucket type situation. So diversification, really important. Sharesies is really great for the choice or being able to choose, when you can get that money out and things like that. So definitely we don't see investing, or the way we talk about investing isn't the get rich quick scheme. It is these longer, medium term goals and being in the driver's seat and building up your portfolio. So huge part
Cool.
of the financial
And the
well-being.
job we're all doing is demystifying money, right, Sonya?
Yeah,
You know, because
totally.
money's actually pretty simple, eh? Like, and you know, Sharesies is saying, you know, I bought my first share when I was 11. I needed to get my parents' written permission, and they needed to go into the stockbroker because I couldn't believe an 11-year-old would want to buy a share. You can't that with what you do now. It's just amazing. And
That's an interesting
yeah.
point. Not everyone starts when they're 11, obviously, and there's a bunch of people that haven't started their journeys yet. So do you have any recommendations on just how you take that first step and how you get started when you feel like you don't really know enough?
Yeah, I think, you know, everyone has a day one. And I think the first thing is acknowledging it's your first day. So why would you know, why don't expect yourself to have to know everything. So I think the most important thing is that you want to and you're curious. I'd say pick an amount you can afford and just give it a crack. So get stuck in, find out what you need to. There's some really great support out there around how to think about this and how to kind of get your first steps, which I think we should share some things in the chat around like blogs and things like that we have that are all about helping you get started. But I think the most important thing is every expert has a day one. And, you know, to Sam's point about demystifying, being present and learning through experience is a huge part of becoming more empowered and this demystifying of money. And I kind of call it anti-marketing when people, you know, of how we ended up here and us all feeling like we can't own our own money or we're not smart enough or whatever those things are that we've been kind of taught that we're not the best people to understand. But I think there's this point where we are all capable of learning about this stuff. And I think the most important thing is, you know, do you have the right support around you and are you curious to get started? And, you know, it's amazing what you'll learn just by doing something day in, day out and kind of making it a part of your life.
I'm so glad you mentioned that experience because it's really about learning by doing. But at one point, when you get into it, at a certain point, you can start to step up a little bit and get a little bit more strategic and start to ask yourself, okay, so this money that I'm investing, what's it for? And how soon am I going to want it back? Because it's one thing, I think it's a really good first step to start buying stuff that actually increases in value, as opposed to most of the stuff that we actually spend money on that actually it decreases. You buy a new car and as you're driving away, you know, suddenly it can be up to 40% that it's lost value. You know, so shares obviously is the difference if you're buying valuable companies. But at one point, you're going to need to ask, you know, what's that money for? What? I'm so glad you mentioned goals, because if you work backwards from your goals, then you can see what you're using vehicles like shares to achieve in life.
Yeah, I think that key takeaway is just get started, and learning by doing is the best way. But just actually building on something that you mentioned, Tom, if you are looking to sort of level up as an investor and take that next step, are there any platforms or resources or anything that you would recommend? Is there anything on the Sorted website perhaps that would help me out with that?
Yeah, so we have our investor Kickstarter tool, and that's really it's just a few questions to really start to measure where you're at, your attitudes towards the ups and downs in the market, your capacity to invest, and about your time horizon, how soon you're hoping to get the money your money back. And it gives you an idea of what your investment mix, your asset allocation might be as you move forward. And it really we have a lot of things on the website that really help you align your investing with your goals. Typically, people have a multitude of goals for the short, medium, and long terms. And you can really use a bucket system in order to invest accordingly to make sure that you're on track to hit your goals. The short-term ones are easier to see. They're a little bit closer in focus. The long-term ones are a little bit more difficult. But you know, a lot of our resources on Sorted are trying to promote and make long-term thinking that much easier.
Awesome. Well,
we've got. Really, can I just add something to that about that kind of looking forward? Because I think that's an important part about investing. And you know, one thing I love about being an investor now, like a surprising byproduct, I guess, is how connected I feel to what's going on in the world and what's going on in the media, and this ability to go, you're kind of philosophizing, like you're just going, hey, well, what do you think that's going to mean for 10 years time? What do you think that's going to do? And you spend all this time kind of asking some cool questions about the future. And I think that is the struggle, because you're balancing these kind of behaviors, which is like the instant gratification and wanting something now, with these long-term things. But I think like what I've been surprised at is how fun thinking long-term now can be when you're reacting to kind of information that's changing all the time. So yeah, I really love that. And, we've got a daily news podcast now, which talks about the top 3 stories or so that's going on in the news. And it's so interesting. And it's like, there is a lot going on every day. And those things will all be having a long-term impact. And by going, I wonder what that will do. It's really fun.
Nice. Well, we actually have a bunch of questions from listeners, so we might just kick on to those. And the first one is for Sam. It's a question and also a little bit of lovely feedback. Is Simplicity looking at adding any more funds to its platform? I would love to be able to invest in something similar to, I'm going to admit I've never heard of these myself, VTSAX or VOO. And they also say that I love Simplicity and currently have my Kiwisaver with you and money in your New Zealand share fund. Keep up the fantastic work.
Thank you. Well, look, we're called Simplicity for a reason. We don't like to have lots, that paradox of choice. We like to keep it really simple and keep a few very large scale, very low fee funds. But I think one area that we might look into is creating a more of an income fund for retirees and people who want a regular income, and for that to be a safe regular income. Because right now, term deposit rates suck, right? Like who can live on that, right? So are there ways of getting income in reliably? And it might be by lending on mortgages, which is what we do now, we're the cheapest mortgage lender in the country. It might be build to rent housing. It might be other ways that we invest in that create a reliable income source and then give people access that way. So we might start looking at that. But if you've got ideas, send it in. And I don't know what VOO is, but boom, sounds pretty interesting. Let's see what that's all about.
Awesome. There's one question here that says, how much do I need to start investing? And I can answer that one. With Sharesies, you only need 1 cent to get started. So the sky is the limit, really.
1 cent. How about that?
1 cent. How about that, eh?
Yeah,
that's the first I heard that. Actually, I always heard it was like $5, $2, something, at least $1, but 1 cent. How about that?
You'd have a well-diversified portfolio for $5. You can, with a 1 cent buy-in.
Amazing.
Another question, anyone feel free to jump in and have a go at answering this one. Someone says, I'm hearing a lot about indexes being at an all-time high. I understand volatility, but I'm keen to understand the risk to investing in this environment. I am on board with long-term holding, but do we assume that the value of businesses will continue to increase over time despite the ups and downs? Therefore, investing now is still sensible?
I'll tell you what, I'll dive in here. I have spent my whole life reading the newspaper which says the market's at all-time highs, sell, right? and if over the last 30 years you missed out on the 10 best trading days, your returns would have halved. If you went in the market for 10 days, don't pay any attention. Well, let me put it this way: if you think if you can predict the future, great. And if you think these other people can predict the future, great. But if you don't, then don't. Just have a diversified a diversified group of shares there, and or a diversified Kiwisaver fund. Because I'll tell you why. Do you know why financial markets go up? It's because every day we wake up and we want lives to be better for our children and grandchildren. So we set up businesses and they make profit and they employ people and people get jobs and we get economic activity. So as long as you believe in human progress, the share markets are going to go up. They won't always go up. They'll go down and down and down. But the share markets just reflect that we want a better life for ourselves and for our whānau. So if you bet that it's going to go down, you're betting against human behavior.
Yeah, and I found that you never want to short human ingenuity because we're always finding new solutions. We're finding new ways of living better. If you look at the progress that has been made. Now, I'm naturally an optimist, but if you look at what's been done and the acceleration of how things continue to get better, sure, there are going to be some companies that fall off. There's lots of examples of those, but then there are others that take their place right away, fill a gap, fill a need, and there's so many entrepreneurs out there who are working to solve the problems that we're facing today. So I think we're going to see more and more value being created, and investing is just a way of supporting that, but also sharing in it.
It's so awesome.
Crazy to short Sharesies.
It's pretty interesting, because when you do go through like times of change, and it was something that we were thinking about before, where it feels like, oh no, lots of things are changing. It's also human behavior to kind of want to create some stability around it. And, it's a really important question to go, what won't change? When there is lots of change going on, what do I think won't change? And, and to Sam's point, it's like people will keep buying stuff, people keep needing things, there will be people that will provide those services, and that, like, do we believe that will continue to go on? And I think what those specific things are might change, and we can see lots of great businesses kind of popping up, and the ingenuity popping up, even with the impact of COVID last year. So you can see this kind of changing but they're just new ways of delivering problems and opportunities for others. So huge.
We've got another question here that says, would you recommend only putting into Kiwisaver the amount to receive the government contribution? And we don't provide advice on these webinars, but I thought maybe it'd be interesting just to talk quickly about what that government contribution is, because some of our listeners might not know how that works.
Yeah, I think in the spirit of explaining how it works, it wouldn't be personalized advice. I think it would be fine. So this is not a directive what to do or what not to do. But one of the things that you need a really good reason not to be in Kiwisaver. And that's because of the incentives going in. It's not just your money that you're putting in being invested. If you're an employee, obviously you're getting an employer matching contribution that makes it worthwhile. But even if you're not an employee, you can get the government contribution, which is 50 cents on every dollar you put in, up to a maximum you can get up to $521 a year. And so that's every year. And if you were to do that over your entire Kiwisaver experience, and that money stayed invested, we estimated that makes about $36,000 worth of difference. So really those incentives really tip the balance in favor of Kiwisaver. But then all of that money gets invested by people like Sam's team, and I know a lot of them, they do a great job, and that money continues to grow and over time and really get great results.
I tell you, and so Tom, you're being too diplomatic, man. Can I get a little bit more vociferous about this? This is free money. Free money. You put in $2, the government will give you $1. So not only is it free, it's the only free money I know. But here's the other thing: you put in $2, the government gives you $1. That is a 50% return on your money. It is also the best returning investment I've ever seen because it's got zero risk. It's unbelievable. It is the best investment ever. I have never seen it. Well, maybe Sharesies is better. Sorry. But it is an incredibly good investment. And you must tell everybody, even if they're saving the minimum amount and paying off their house, every adult must have a Kiwisaver account. I don't even care if you have it with one of our horrible competitors. Get it in there, put the money in. The government will give you free money.
Wow. On that note, we've actually run out of time. What a great way to end. Thank you for tuning in, everyone. And a very special thank you to our guests for joining us. We really appreciate your time and all of your expertise as well. Sorted, Sharesies, simplicity. The three S's of money. Gosh, that went so fast. We must be having fun. Thank you so much. Next Thursday, we will be joined by Zoe Wallace. Zoe is the Chief Economist for Deloitte New Zealand, and she'll be discussing the Reserve Bank of New Zealand's announcement on the official cash rate that's coming out next Wednesday. You can register through the link in the chat. Also, check out our new daily financial news podcast, Recap. Sonya mentioned it earlier, and it's around 10 minutes long and published at 5 p.m. Monday to Friday on Spotify, Apple Podcasts, and Google Podcasts. I've really been enjoying adding that to my daily routine, and I'm feeling much more up to date on the financial news as a result. Enjoy the rest of your week, everyone. We'll see you next Thursday. Thanks.
Thank you,
Have a
Erin.
great money week.
See ya.
Thanks,
Bye.
everyone.